Hello everyone, welcome to Stewardship Finance Academy. OpenAI is, without a doubt, the leader of this AI revolution. Ever since ChatGPT burst onto the scene in 2022, the entire tech industry has been completely transformed. And now, in 2025, OpenAI's role seems to be shifting once again. It has evolved from a tech pioneer into a commander stirring up the US stock market. Think about it. Its contract with Oracle reportedly sent that stocks soaring 40% instantly. Its partnership with AMD apparently drove their stock up 60% in just 2 weeks. Even tech giants like Nvidia, Microsoft, Amazon, and Google have seen their stocks rise round after round thanks to working with OpenAI. And it's not just tech. Consumer companies like Walmart, Shopify, and Expedia have seen their stocks take off just by integrating ChatGPT. Don't think OpenAI can only make stocks rise. It's got a knack for making them fall too. It announced Sora, and Meta's stock reportedly dropped 5%. It hinted at a browser, and Google's stock fell 5%. Just recently, OpenAI mentioned it might have financial problems. And that one statement seemed to trigger a pullback in the entire US market. The OpenAI of today looks just like a US stock market commander. It feels like it can make stocks rise or fall at its whim. It's even starting to influence the entire market's direction. For us investors, understanding OpenAI's real impact on the US market has clearly become one of the most important things we can do. In today's video, we're going to dive deep into this market commander, OpenAI. We will explore the hidden meanings behind its recent, frequent, major moves. How will it specifically affect US companies? Which companies might see real opportunities, and which could face major risks? Let's first briefly summarize OpenAI's recent big moves. I've divided these actions into two main categories. First, strategic moves related to computing power. Second, experiments at the application layer. The first one is the core force rattling the current market. The second one points to where the future opportunities in the US market may lie. We'll analyze them separately. 1. The compute strategy. In September, OpenAI signed a 5-year, $300 billion supercomputing order with Oracle. Immediately after, it reached a 10-plus GW computing power partnership with NVIDIA. With NVIDIA planning to invest $100 billion to support OpenAI's GPU purchasing needs. Then, OpenAI teamed up with AMD to deploy 6 gigawatts of computing power. In exchange, OpenAI gets a chance to acquire about 10% of AMD's stock. Just when the market thought this expansion was aggressive enough, OpenAI unexpectedly partnered with Broadcom to jointly plan a 10-plus GW-level production line for its own self-developed chips. Soon after, OpenAI signed a new long-term agreement with its old partner, Microsoft. The exclusive binding to Azure was officially lifted. In exchange, Microsoft gets about 27% of OpenAI's equity. And OpenAI signs a $250 billion Azure cloud service procurement contract. Just last week, OpenAI also reached a deal with Amazon AWS, signing a $38 billion computing power procurement service contract, becoming an official strategic partner. Add in its previous cooperation with Google Cloud and strategic signings with Samsung and Hynix for memory chips, and you can see OpenAI has essentially swept through the entire computing power supply chain. Just a few short months, from chips to cloud, from equipment to storage, OpenAI has been everywhere, has truly built a global computing empire for itself. So why is OpenAI spending so much energy on compute? The most direct reason, of course, is to alleviate the current compute shortage, which has hindered progress in large model training. Company CFO Sarah Fryer stated that due to shortages in computing resources, the company often has to delay the release of new features or AI models, and sometimes even intentionally slows down the performance of some products. In short, the compute shortage has become the single biggest bottleneck constraining OpenAI's model iteration. However, behind this lies a deeper intention that investors often overlook. In the past few years, OpenAI's compute has been almost entirely dependent on two companies, NVIDIA and Microsoft. NVIDIA's GPUs are the only hardware that can support large model training, and Microsoft provided a lifeline when OpenAI needed capital the most, making the Azure cloud its sole cloud partner. But as OpenAI has grown larger, this high degree of dependence has gradually become a threat. Ideally, the AI technology company should be the dominant player in the AI industry chain. But the reality is that currently, almost all the profits and dominance are concentrated in the upstream foundational layer, especially with Microsoft and NVIDIA. OpenAI is clearly unwilling to be led by the nose by its upstream suppliers. To break this pattern of high dependence, finding new suppliers is imperative. So we see OpenAI not only cooperating with almost every cloud computing provider on the market, but also signing agreements with almost all upstream chip companies. This is all part of a strategy to diversify the compute supply and break that previous exclusive reliance. So what is the real goal here? Diversifying the compute supply isn't just about getting more compute. More importantly, it's about helping the company reduce costs, increase profits, and ultimately gain a greater voice in the industry. In fact, while NVIDIA's chips are indeed powerful, many low-intensity training or inference scenarios simply don't require that much computing power. If OpenAI can allocate compute based on user tiers and task types in the future, it could effectively reduce compute costs and improve operational efficiency. This in turn could promote model iteration and achieve higher commercial value. On the other hand, if a bottleneck appears anywhere in the upstream supply, diversification allows OpenAI to find alternatives from other suppliers, improving supply chain security. And the very existence of these alternatives becomes a card OpenAI can play, giving it greater bargaining power when negotiating with giants like NVIDIA. So you see, on the surface, OpenAI's moves seem to be about buying compute. But in reality, it's about enhancing its own initiative within the entire AI industry chain. The goal is to ultimately reduce costs, improve profits, and increase supply chain security. Essentially, it wants to break the current structure where the AI industry is controlled by the upstream, its foundational layer, and carve out a larger share of the profit for itself. So, what impact will this diversification strategy have on the compute industry as a whole? If OpenAI wants to shift more profits to itself, does that mean profits for companies like NVIDIA and Microsoft will be squeezed? We need to look at this in different timeframes. In the short term, OpenAI's biggest impact isn't changing the industry structure. It's single-handedly pushing global compute demand to a new high. OpenAI CEO Sam Altman revealed that OpenAI has so far committed about $1.4 trillion to infrastructure, which translates to about 30-plus GW of data center capacity. This scale is equivalent to dozens of global-level supercomputing centers. Therefore, the entire upstream of the AI industry chain, from chips and storage to cloud infrastructure, will likely be driven into a new round of expansion by OpenAI. From the perspective of the entire industry chain, as long as OpenAI is still spending money, the entire compute industry will probably benefit. On the other hand, I believe that at this stage, it's very difficult for OpenAI to truly change the structure of the compute industry. NVIDIA remains the irreplaceable GPU supplier. The hardware-software moat created by its CUDA ecosystem is not something AMD or Broadcom can likely catch up to in 3 to 5 years. Meanwhile, Microsoft, AWS, and Google still firmly control the cloud computing market. Their scale, ecosystem, and customer stickiness are not easily challenged by new players. Most importantly, at this stage, the entire industry's demand for compute is staggering. Companies facing supply shortages will likely continue to face them. The so-called alternatives OpenAI is seeking probably can't change its bargaining power right now. They are more about escaping over-reliance and securing more compute. It's far from changing the game. The competitiveness of upstream compute players still depends on their own technology, ecosystem, and scale. 2. The application layer. If OpenAI's moves in compute are just a reshaping of the existing US stock landscape, then its explorations in the application space are a preview of future opportunities. Only by understanding these moves can you grasp the real opportunities ahead and avoid the risks of being disrupted. First, let's quickly review OpenAI's recent moves at the application layer. In May, OpenAI appointed Simo as its first chief application officer, responsible for the company's commercialization exploration. Simo previously led video advertising and monetization at Meta and later served as CEO of Instacart, where she built the advertising business as its second growth curve. This shows she is an expert who really understands monetization. In September, OpenAI launched the brand new Sora 2 and simultaneously released the standalone Sora app. This is a short video platform driven entirely by AI-generated content, aimed directly at social media leader Meta. Immediately after, OpenAI launched the heavyweight instant checkout feature. Users can complete the entire shopping process from searching for products to selection, payment, and logistics tracking, all within the ChatGPT interface without redirection. This marks the company's initial functional setup for its AI agent strategy. This move has made many e-commerce platforms nervous. Then, at OpenAI's Developer Day, they announced partnerships with various applications like Spotify, Expedia, and Walmart, having them all integrate with ChatGPT, thus locking in a large number of partners. In October, OpenAI dropped another bombshell, launching Atlas, a browser with built-in ChatGPT, seemingly gearing up for a head-to-head competition with Google. Behind these actions, OpenAI looks like a big bad wolf, wielding the sharp sword of large models, slashing at existing business models everywhere. When it cuts, stock prices seem to fall. The question is disrupting existing industries really OpenAI's strategic goal? Why would a company known for being technology-driven suddenly start developing application services so frequently? To answer this, we must first understand the broader context of the AI industry. The logic of competition is slowly changing. Early AI competition was all about models and compute. Whoever had the bigger model and more GPUs had the competitive edge. But now the gap between models seems to be gradually narrowing. For example, when OpenAI launched the latest GPT-5 in August, its improvement on traditional capability tests was reportedly very limited. The GPQA accuracy, for instance, was said to only rise from 83.3% to 88.4%. Currently, the performance gap between various general large models, whether it's Gemini or Claude, is getting smaller. Plus, With all large model companies frantically investing in compute power is no longer OpenAI's exclusive moat. So, when models become more homogenized, the battlefield will inevitably shift from pure model strength to other areas. Even if it hasn't truly happened yet, large models are still the main battleground this trend has begun. Strategic shift will likely be the dominant trend of the future. And following this trend, AI applications are the necessary next step in the large model competition. Why do I say that? Let's look at some numbers. In the first half of this year alone, OpenAI's R&D expenditure reportedly reached $6.7 billion. Stock-based compensation was $2.5 billion, and marketing was $2 billion for a total of $11.2 billion. The full-year estimate is at least $23 billion. Meanwhile, revenue is projected at about $13 billion. This leaves a $10 billion deficit. According to a report from The Information, by 2029, OpenAI's cumulative investment in server leasing is expected to reach $450 billion, with a total cash burn of about $115 billion. The company may find it very difficult to achieve positive cash flow before 2030. Although OpenAI can solve some financial pressure through fundraising, in the long run, this burn rate cannot be sustained by external blood transfusions alone, and the current subscription model is hardly enough. OpenAI must rely on new business models to provide cash flow and achieve a self-sustaining cycle. Looked at this way, AI applications are an unavoidable path. This has also been confirmed by OpenAI itself. This chart shows OpenAI's own long-term revenue projections and breakdown. As you can see, by 2030, AI agents and the monetization of free users are expected to contribute about 40% of revenue. We all know what AI agents are. Monetizing free users clearly refers to advertising. These two revenue streams are completely non-existent right now. OpenAI must build them, or else the company simply won't last long on fundraising and subscription models alone. Now, some might say, aren't startups just about selling a story, selling a vision? As long as OpenAI's large model stays ahead, why worry about investors not giving money? The truth is, that's not enough, because startups also face valuation pressure. According to media reports, OpenAI's current valuation is as high as $500 billion. But its 2025 revenue is projected at only $13 billion. That's a price-to-sales PS multiple as high as 40x. For the company to maintain this valuation and continue raising funds, it must explore new monetization channels. According to the company's own projections, revenue must reach at least $200 billion by 2030. A massive scale like that certainly can't be achieved by charging $20 a month for subscriptions. So AI agents and advertising are business models that must be implemented. This high valuation isn't just for fundraising. To retain talent, the company's stock-based compensation is also crucial, and that's tied to the valuation. Furthermore, as mentioned earlier, the valuation is a key bargaining chip in many of those massive compute deals. The company can only lock in future compute by maintaining a high valuation. So you see, even a powerhouse like OpenAI has to bow to capital. The pressure of a high valuation, combined with the homogenization of large models, is forcing them to seek breakthroughs in new application areas to maintain their competitiveness. This is why we've seen the company so urgently searching for monetization paths recently. So, the most critical question is, how exactly does OpenAI plan to monetize? The answer to this question will help determine what opportunities lie ahead for the US market, and which companies might face the risk of disruption. On the surface, OpenAI seems to be doing everything, looking like it wants to smash the old system and build a new world. But don't be alarmed. In my view, OpenAI's current moves are more about exploration than actual disruption. The reason is simple. First, OpenAI simply doesn't have the ability to go head-to-head with the current internet giants on their business models. Whether it's big tech like Meta and Google, or consumer stocks like Shopify and Walmart, they all have user bases and business ecosystems built over many years. If you want to compete directly, it's absolutely not something you can do with technology alone. Second, OpenAI can't really do everything. Its resources can't cover so many applications. Landing any application depends not just on technology, but also on deep cultivation in operations, sales, and various other fields. OpenAI is a startup that can't even fully manage its own large model technology right now. It's impossible for it to take care of applications in multiple fields. So, in my opinion, OpenAI is currently in a wide net exploratory phase. It's just dipping its toe in various fields to test the water. Ultimately, it can only focus on conquering one or two key application areas. And as for the situation right now, while monetization is a necessary path, it hasn't reached a succeed or die moment. The company still has time to explore. From this perspective, we investors don't need to take OpenAI's application experiments too seriously. Before a final direction is set, existing business models are unlikely to be truly impacted. So, what will that final direction be? After all the logical reasoning above, the final answer is about to surface. For any technology-driven tech giant, the most viable path to landing a business model is to first acquire users, then talk monetization. As long as you have enough users OpenAI, I can apply any existing mature monetization model like advertising, subscriptions, or commissions. So the most important thing isn't monetization, but users. In my opinion, OpenAI's most important task right now is to become a high-frequency traffic portal. From this perspective, I believe the least likely thing for OpenAI to do is become an entertainment portal. The recently launched Sora, in my view, will struggle to succeed. This is because AI video demands too much computing power. Current compute simply cannot support Sora generating enough video content for entertainment, and it will take too long to cross that chasm. From a monetization efficiency standpoint, this method is clearly not cost-effective. In my opinion, there are only two directions that will truly materialize in the future. One will bring opportunity, and one will bring risk. The first category, I believe, is synergistic use with various lifestyle applications. Some say that with ChatGPT, people will no longer use e-commerce or lifestyle platforms like Expedia. I don't think so. It's not easy for ChatGPT to build its own consumer and merchant ecosystem. Even with superior large model technology, it's hard to achieve this in a short time. I believe a better approach is to partner with existing lifestyle and consumer apps, letting them integrate ChatGPT to better help users complete transactions. For OpenAI, its goal is to become the traffic portal for consumer scenarios, helping people make better purchasing decisions, so thereby retaining users in those consumer scenarios and keeping them in its ecosystem longer. This means that for those existing consumer app companies, ChatGPT won't disrupt them. Instead, it could be a promoter. Take Amazon's e-commerce as an example. Users who already have a clear intention to shop on Amazon will most likely still shop on Amazon. Because in an identical scenario, you must provide a significant improvement to change user habits. If the experience is just about the same, users will prefer to use the application they are familiar with. It's just like how, even though Google can also search for products, people still prefer to shop directly on Amazon. I believe it's difficult for ChatGPT to impact Amazon within its existing e-commerce scenario. What ChatGPT is more likely to do is bring new e-commerce consumption scenarios. For example, recommending products while people are asking questions. It's like when users are browsing TikTok. They were originally just looking at content, but then smoothly entered a shopping process. This creates a new conversion scenario. ChatGPT could be the same. A user might have originally just been asking which product is good and ended up making a purchase right then. So in my view, for e-commerce and other consumer apps, ChatGPT is more about bringing new usage scenarios and thus new revenue. It's more of a boost than an absolute disruption. However, the situation is different for the other category of OpenAI's application exploration. Think about it. What is ChatGPT guaranteed to be able to do? It is already a major traffic portal. Today, ChatGPT's weekly active users reportedly exceed 800 million. And what is this traffic for? It's not a direct consumer scenario, nor is it an entertainment scenario. It is a typical search scenario. Its traffic portal is almost identical to that of the current search giant Google. So, will OpenAI's monetization impact Google? I'm sure some viewers will say, look, since ChatGPT appeared, Google's performance hasn't been affected at all. In fact, it's still growing, and its stock has done well, right? It's true, Google's performance has been good, and its Gemini model is also developing well. Although ChatGPT has siphoned off some traffic, it hasn't substantially impacted Google's earnings. But the problem is, OpenAI hasn't started advertising monetization yet. Right now, advertisers in the search scenario still have to rely on Google as the only portal. So even though ChatGPT is also a massive traffic gate, advertisers still have to go to Google for promotion. But once OpenAI starts ad monetization, the situation could change. Because wherever the traffic is, that's where advertisers' budgets will likely follow. In the future, the search advertising budget that originally belonged exclusively to Google could be siphoned off, bit by bit, to ChatGPT. This could directly impact Google's earnings. Some might say, doesn't Google have Gemini? Yes, Google's Gemini is arguably just as good as ChatGPT now. But the problem is, Google doesn't just want a competitive advantage, it needs a monopoly. In the past, Google was the lone giant. All the traffic was in its hands, and all advertisers had to go through it. But now, as long as Google's Gemini cannot completely crush ChatGPT, Claude, and other models, even if they only take away a small fraction of the traffic, Google could suffer, because their portals are almost identical. Siphoning off traffic means siphoning off advertisers, which means a real and substantial impact on revenue growth and profit margins. And for OpenAI, ad monetization is arguably its simplest and most direct path to monetization. With over 800 million users, it already has a certain scale. And the question and answer scenario is perfectly suited for inserting ads. It's very likely that, compared to the entertainment and e-commerce scenarios mentioned above, ad monetization will be the company's first tool and monetization scenario. This further increases the risk of Google being impacted. The only question now is when OpenAI will start advertising monetization. Till OpenAI truly enters the monetization game, Google's earnings should be relatively safe. It's still a company with strong technology and operations. But once OpenAI does start ad monetization, Google could suffer a substantial impact. For a company where over 80% of its operating profit comes from search advertising, this is, in my view, like a ticking time bomb, constantly threatening the Google investment. Navigating complex risks like this is arguably the hardest part of investing. If you want to get better at spotting these kinds of threats and opportunities, we're actually hosting a free stock investment masterclass to share our framework. It's completely free, and the link is right in the description. Our analysis is never about predicting tomorrow's stock price. It's about providing a way of thinking as a reference for long-term investment. The problem of AI siphoning off search ad revenue has always existed. The difficult choice of disrupting oneself has never disappeared. Just don't know when it will happen. Before it happens, the company can indeed perform well based on its operations. But once it does happen, management will need immense resolve to make changes, and the difficulty of that change will be extreme. Perhaps a great company like Google will ultimately find a way out. I believe investing should stick to doing the easy things. My analysis today is also based on being as objective as possible. I hope to have a rational discussion with everyone. So, what are your thoughts? Is Google's dominance truly at risk from OpenAI? Or is this just the healthy competition it needs to innovate? I'd love to read your analysis in the comments below. Thank you so much for joining me today at Stewardship Finance Academy. If you found this breakdown valuable, please give this video a like. It really helps the channel. And if you want to make sure you never miss an analysis, be sure to subscribe and click that notification bell. We dive deep into the biggest market-moving topics every single week. Don't forget, if you're serious about leveling up your own investment framework, check out that free masterclass I mentioned. The link is right in the description. Thanks again for watching. I'll see you in the next video.